With prices having recovered from the March 2020 lows, it is time for investors to do some stock picking within the S-REIT space. Find out which S-REITs will shine in 2021 and which ones you might want to avoid. Up next, we have Yeo Hui Shi, Equity Analyst, Stocks and ETFs Research, IFA Singapore, to present Rest in Peace or Rage On. Is 2021 the year for REITs to shine?
Good evening, everyone. I'm Hui Shi from the Stocks and ETFs Research Team, and I'm here today to share with you our outlook for REITs in 2021. But before we go into that, let us first take a look back at how REITs have performed in 2020. So in 2020, we noticed that there was a performance divergence within the S-REIT sector. The data center REITs and the industrial REITs were the most resilient, while the remaining were being hit by COVID-19. Hospitality REITs were hit the hardest, followed by the retail and then the office REITs. But this is no surprise since COVID-19 it has grounded airplanes, hotels are empty except for the guests who are there to serve their stay-home notice. And as a result, hospitality REITs were the worst performing REITs of 2020. And that is not all. COVID-19 it has also changed the way we live and the way we work. And as a result, it has accelerated certain structural trends such as the shift towards e-commerce as well as the adoption of working from home. These trends, they have benefited the industrial as well as the data center REITs, but exact same trends have also dragged down the retail and office REITs. On a more positive note, the share prices of REITs have recovered from their March 2020 lows, and the sector still has some way to go before reaching their pre-COVID levels. However, as share prices have been recovering, this also means that current valuations are not as attractive as they were as compared to the first half of 2020. And keeping in mind those structural trends which are changing our world, we believe that not all REITs are able to recover back to their pre-COVID levels in 2021. And so we believe that investors should be selective when investing in REITs in 2021. So now I'll be going through the outlook for the different sub-segments of REITs and highlight our stock picks for 2021. Let us first start with the hospitality REITs, which have been hit the hardest by COVID-19. Following a challenging year, the good news for hospitality REITs is that the rollout of vaccines will strengthen their recovery this year. In fact, billions of people are expected to be vaccinated in this year alone. However, we would like to acknowledge the point that it takes time for governments to reopen their borders, and so we expect a full recovery of hospitality REITs to extend beyond 2021. And the Singapore Tourism Board has estimated that a full recovery could take up to 3 to 5 years. But fret not, most of the hospitality REITs, they are backed by master leases. And under such master lease agreements, the REITs receive two different components of rent. One is a fixed rent and the other is variable rent. Variable rent is dependent on the hotel's gross operating revenue as well as gross operating profit. And during the pandemic, with hotels being empty, the REITs have received little to no variable rent. However, they have continued to receive fixed rentals, which is independent of the revenue as well as the profit. And so this fixed rent actually serves as a downside protection and a minimum guarantee which helps to limit the downside risk to the income of hospitality REITs while we wait for a full recovery. And looking further ahead, we would like to remind investors that the long-term catalyst of Singapore's tourism industry still remains intact. There are various tourism developments in the pipeline that will be able to support the continued growth of tourist arrivals in the longer term. And these developments include the expansion of Resort World Sentosa, the Mandai Nature Precinct, and the Jurong Lake District, just to name a few. And so we believe that investors should also be able to take a long-term view when it comes to investing into such hospitality REITs. There are various hospitality REITs out there, but our stock pick for 2021 is Ascott Residence Trust. Ascott Residence Trust has a large exposure to countries with sizable domestic markets such as Japan, Europe, US, as well as China. It takes time for governments to reopen their borders, and so we expect that domestic travel will recover at a much faster pace as compared to international travel. And so we believe that art will be one of the first hospitality REITs to reach its pre-COVID levels. We expect the DPU of art to grow at double digits over the next few years, with a yield of close to 6% in 2022. And as you can see from this chart here, the share price of art tracks its DPU. And with its DPU set to recover over the next few years, we believe that the share price of art definitely has room for upside potential. And now I'll move on to the outlook for retail REITs, since Singapore has entered into the widely anticipated phase 3 of reopening. For retail REITs, we believe that those with suburban malls will be able to stay resilient. As Singapore has entered into the phase 3 of reopening, we believe that suburban malls will be able to recover back to its pre-COVID levels. I'm sure many REIT investors should be familiar with Fraser Centrepoint Trust, which predominantly holds suburban malls. And as of October 2020, the tenant sales of FCT have already recovered to near pre-COVID levels. And with the phase 3 reopening, we believe that FCT is well on track to reach a full recovery by the end of this year. Furthermore, suburban malls, they tend to focus on essential goods and services. And essential goods are more resilient against the competition from e-commerce. And this chart here shows that the online sales proportion for supermarkets, which is denoted by the blue line, had remained relatively stable in 2020. Even during the circuit breaker period, which lasted from April to June. And in contrast, during the same period, you can see that other industries which are less essential saw a spike in their online sales proportion, suggesting that they are less resilient against the competition from e-commerce. And furthermore, apart from the focus on essential goods and services, suburban malls, they have a close proximity to densely populated residential areas. And we believe that this further supports their ability to be more resilient against e-commerce. And meanwhile, as compared to the suburban malls, we believe that downtown malls, they will face more intense competition from e-commerce, and they also take more time to recover. Downtown malls, they are more reliant on tourists as well as office workers. Borders, they will take time to reopen, and some office workers in the CBD are still working from home. And so we expect the recovery of downtown malls to lag behind that of the suburban malls. And also, unlike the suburban malls which focus on essential goods and services, downtown malls, they face more intense competition from e-commerce. And as a result, we expect the rental rates of downtown malls to remain under pressure going forward. I'm sure many investors are familiar with CapitaLand Integrated Commercial Trust, CICT, which is the product of the recent merger between CapitaLand Mall Trust and CapitaLand Commercial Trust. And yes, CICT, it is currently the largest S-REIT, but there's one point that we are not so positive on about FCT, and that is the fact that it will be progressively taking on more risk from its tenants. Going forward, more of CICT's rentals will be charged based on the turnover of its tenants. So what this potentially means is that if its tenant sales remain weak, then CICT's income will be negatively affected. And we also need to keep in mind that CICT has exposure to downtown malls. And as I mentioned earlier, downtown malls, they are facing more intense competition from e-commerce. And so we see this as a negative for CICT, since there will be more downside risk to income that can be distributed to unit holders in the future. And hence, our stock pick for retail REITs is actually Fraser Centrepoint Trust. FCT holds a portfolio of resilient suburban malls, and we expect the DPU of FCT to rebound back to its pre-COVID levels by the end of this year, with a yield of about 5%. And once again, you can see that FCT's share price tracks its DPU, and so we believe that FCT share price has room for upside potential as well. And now I'll move on to the outlook for office REITs. With many of us working from home during the pandemic, it is safe to say that 2020 was not a good year for the office REITs. And even as we enter into the new year, the long-term outlook for office REITs still remains uncertain. Even as there are more employees who are going back to their offices during phase 3, there are also more companies who are starting to embrace working from home as a permanent arrangement post-COVID. And so we expect office demand to remain weak, with tenants either taking a wait-and-see approach when it comes to expansions or renewals. And for some, they may be asking for shorter and more flexible lease terms as they figure out their future office needs. And so we expect the occupancy rates and rental rates of office REITs to continue to fall this year. But despite all these negatives, there is still a bright spot within the office segment. And this bright spot is the healthy demand from the rapidly expanding tech sector. Tech companies, they have continued to lease office spaces despite them having work from home arrangements. And we believe that this can be attributed to the fact that they have been expanding rapidly thanks to COVID-19. So for instance, in the context of Singapore, the Chinese tech giants such as Tencent, they have announced that they are coming over to set up offices. And we believe that such positive developments can help to partially offset the overall reduction in office demand in Singapore. And over in the US, the story is similar. Tech giants like Amazon, Microsoft, they have continued to lease office spaces during the COVID-19 pandemic. And this is even as when they are allowing their employees to work from home until the end of this year, and for some, even permanently. And so this is why we think that office REITs with high exposure to demand from the tech sector should be able to fare much better as compared to its peers. And one such REIT is Keppel Pacific Oak US REIT, which is focused on the growing US tech hubs, such as Seattle, which is where tech giants like Amazon are headquartered at. Its largest exposure is to the city of Seattle, followed by Denver and Austin. In 2020, despite the COVID-19 pandemic, this REIT has managed to record positive double digits rental reversions, and this is mainly attributed to the new and expansion leases from the tech hubs. And looking into 2021, we believe that this REIT will continue to record positive rental reversions, but at a slightly smaller magnitude, possibly in the high single digits due to the economic uncertainties. And one interesting thing to note about such US office REITs is that they have built-in annual rental escalation. This REIT has an annual rental escalation of 2.7%, which means that the office rental rates under this REIT will step up by 2.7% every year. So this actually provides it with opportunities for organic growth and can help to cushion the impact from the falling market rental rates. We have a target price for Keppel Pacific Oak US REIT, which is at 79 cents, and this will translate to an upside potential of about 14%. And to add the icing on the cake, this REIT is yielding at a whopping 9% and is considered as one of the highest yielding S-REITs right now. And last but not least, we have the industrial and the data center REITs. 2020 was definitely a good year for them, but the question here is, can their resilient performance continue? And the short answer is yes. We believe that this industrial and data center REITs will remain resilient and will be able to continue to outperform the broader REIT sector in the longer term. And the growth of such REITs is mainly driven by structural trends such as the acceleration of e-commerce as well as the shift towards cloud services. The acceleration of e-commerce will drive higher demand for warehouse spaces, while the shift towards cloud services as more companies adopt remote working, as well as the future adoption of 5G will drive higher data traffic, and this will lead to a higher demand for data centers going forward. And one REIT that is well positioned to benefit from such trends is Ascott REIT. Ascott REIT holds a diversified portfolio of assets such as logistic properties, US data centers, and suburban office portfolios. Its logistic properties and data centers will be able to benefit from the structural trends which I mentioned earlier. One additional point to note about A-REIT is its suburban office portfolio. As offices are facing structural challenges, S-REIT has recently expanded its suburban office portfolio to include US offices, which are well positioned to benefit from the demand from the burgeoning tech and life science sectors. Tech and life science companies have continued to lease office spaces since they have expanded rapidly thanks to COVID-19. Moreover, S-REIT has a low gearing ratio, leaving a debt headroom of a whopping $4 billion, and this is enough for the REIT to make even more acquisitions to drive inorganic growth, and also to continue to future-proof its portfolio and to be a better reflection of the post-COVID economy. And we believe that this will be another catalyst that will drive S-REIT's growth in the longer term. We expect the DPU of S-REIT to remain resilient with its growth mainly driven by acquisitions as well as improvement in rental reversions. And we believe that S-REIT's share price has room for upside potential with a decent yield of close to 6% in 2022, which is considered as a bargain for such blue-chip industrial REITs. And so all in all, based on what I've shared earlier, the S-REITs are headed for an uneven recovery in 2021. And as share prices have recovered from their March 2020 lows, we believe that investors should be careful and also selective when it comes to investing in S-REITs going forward. With the rollout of vaccines as well as the phase 3 reopening, we believe that hospitality REITs and suburban retail REITs are well positioned for a recovery. The full recovery of hospitality REITs will take a few years, but for the suburban retail REITs, we believe that they will be able to reach a full recovery by the end of this year. And looking into 2021 and the years beyond, we believe that industrial and data center REITs will continue to deliver resilient growth. On the other hand, the long-term outlook for office REITs remains uncertain, but we believe that those with higher exposure to demand from the burgeoning tech sector will be able to fare much better as compared to its peers. And so this slide here summarizes our stock picks for REITs in 2021. The rollout of vaccines will support the recovery of hospitality REITs, but since time is needed for governments to reopen their borders, we believe that domestic travel will recover at a much faster pace as compared to international travel. And so our stock pick is Ascott Residence Trust for its large exposure to countries with sizable domestic markets. And for retail REITs, we believe that those with exposure to suburban malls will be able to stay resilient due to its focus on essential goods and services, as well as its close proximity to densely populated residential areas. And so our stock pick will be Fraser's Centrepoint Trust, which has a portfolio of resilient suburban malls. And for the office REITs, even though work from home remains as a threat, there is still a certain opportunity within this segment. And this opportunity lies within the tech sector. As tech companies, they have continued to lease office spaces despite them having work from home arrangements. And so our stock pick will be Keppel Pacific Oak US REIT. And last but not least, for the industrial and data center REITs, we believe that their growth will be driven by structural trends such as the acceleration of e-commerce and the growth of cloud services. And so our stock pick is Ascendus REIT for its diversified portfolio of assets that includes logistic properties as well as data centers. And so this will sum up our 2021 outlook for REITs. Thank you for joining me in today's session. So now I'll pass the time back to the MC. Thank you.